It began with a phone call no one was supposed to trace. A trader in London's Canary Wharf, speaking in coded phrases, wired $500 million to a private account in Zurich. Within minutes, the money was gone, rerouted through a series of dormant shell companies. One registered in Cyprus, another in the British Virgin Islands, and a third, curiously, in the name of a dissolved charity. The transaction never appeared on any regulatory radar. Yet, within hours, the Japanese yen spiked 3% against the dollar. No one on the trading floor knew why. But somewhere, someone had just made a fortune. They called it shadow capital, money that existed everywhere and nowhere for decades. The global financial system has been shaped by a handful of visible giants. Hedge funds like Bridgewater, Citadel, or Renaissance Technologies, firms with offices, CEOs, and public track records. But beyond them lies another ecosystem, hidden from public scrutiny. An unregulated network of funds that have no websites, no official filings, and no accountability. They are the unseen forces of global finance. The underground hedge funds. By definition, a hedge fund operates to exploit inefficiencies, to make money where others see chaos. But when regulation tightened in the early 2000s and the war on financial secrecy intensified, some funds chose another path. They moved into the shadows, blending private wealth, political interests, and offshore law into a new kind of power structure, one that thrives on opacity. These are not just funds. They are mechanisms of influence. Behind them stand former intelligence officers, retired central bankers, oligarchs, and even governments. They share one unspoken rule. If you can't control the system, you manipulate it from the dark. The first traces of this hidden world date back to the late 1980s, the golden age of deregulation. London's Big Bang of 1986 tore down the walls between investment banking and trading. Across the Atlantic, Reagan's America embraced the gospel of the free market. Money flowed freely, fast, and without questions. For the first time, financial innovation outpaced the law. This was when secrecy became an asset. Private banking in Switzerland offered anonymity. Offshore havens like the Cayman Islands and Bermuda provided tax shields. Wealthy investors realized they could move billions without leaving a paper trail if they knew the right lawyers and the right accountants. Soon, the world's richest began pooling their assets in secret investment vehicles. They weren't yet called shadow funds, but their DNA was the same: private, discreet, and powerful. One of the earliest examples was the so-called Zurich Circle, an informal consortium of 5 family offices that quietly managed over $30 billion by the mid-1990s. Officially, they invested in currency arbitrage and sovereign bonds. In reality, they speculated on geopolitical instability, betting on coups, crises, and elections. When the Italian lira crashed in 1992 after George Soros famously shorted it, members of the Zurich Circle had already positioned themselves. Some even provided the liquidity that made the short possible. They didn't move markets with press releases, they moved them through silence, and this silence became their shield. Unlike public hedge funds, these shadow entities don't report to investors or regulators. Their capital comes from private networks, old money, organized crime syndicates, discreet royals, and sometimes intelligence-linked entities. One insider once described them as private intelligence agencies with better funding. They exist on the edge of legality, not illegal enough to be shut down, but too opaque to be audited. A London-based compliance officer recalls a transaction that never happened: the client's company was registered in Panama, owned by a trust in Liechtenstein, and managed by a fund in Curacao. By the time you traced it, you'd hit 5 different jurisdictions, all with secrecy laws. It's a loop designed to exhaust you. The point was never to hide from taxes. It was to hide intent. During the 2008 financial crisis, when most markets collapsed, several of these anonymous funds quietly thrived. While Lehman Brothers crumbled and the world stared at the headlines, hidden capital shifted positions, betting on sovereign defaults, commodity spikes, and even bailouts. In one case, a previously unknown entity, registered in the Isle of Man, bought up short-term U.S. Treasury notes days before the Federal Reserve's emergency announcement, profiting nearly $400 million. Overnight, no one knew who owned it. Later investigations revealed the directors were ghost names, men who didn't exist outside the documents. But the money trail led back to accounts tied to a Moscow investment group and a Middle Eastern sovereign fund. The conclusion was chilling. These shadow funds were coordinated, not coincidental. In a post-crisis world obsessed with transparency. The irony is that financial darkness only grew deeper. New regulations like FATCA, MiFID, and Dodd-Frank were meant to track capital flows. Instead, they drove secrecy further underground. Funds began using decentralized networks, proxy trading through family offices, and algorithmic execution designed to blur transaction origins. One financial investigator for the European Central Bank described it succinctly. They stopped existing in the way we can measure. The system was built to catch old-school fraud, not digital shadows. And so, as the visible banking world embraced compliance and risk management, an invisible parallel market, a financial darknet, took its place. By 2020, researchers at the University of Amsterdam estimated that between 15% and 25% of global hedge fund assets were managed through unregistered entities. If accurate, that would mean over $2 trillion in capital moves through invisible hands, trillions, without a name, without a country, without oversight to the public. These funds don't exist, but their fingerprints are everywhere. On currency crashes, commodity spikes, election year capital surges, and even wars. They have no logos, no CEOs, and no accountability. Only one truth defines them. Power flows where light does not reach. Every empire has its architects. For the world of hidden hedge funds, they weren't men in suits giving press conferences. They were lawyers, traders, and ex-intelligence officers who understood one simple fact: control money, and you control the future. It started in quiet offices above law firms in London, Geneva, and New York, rooms with no signs, no publicity, and yet their clients ran the planet. They weren't creating new financial products. They were designing invisibility. In the 1990s, globalization changed everything. The Berlin Wall had fallen, Eastern Europe was opening up, and trillions of dollars of state assets were suddenly up for grabs. The world needed intermediaries, people who could move capital from one jurisdiction to another without questions, taxes, or headlines. This was the golden era of financial engineering. Banks like Credit Suisse, UBS, and Deutsche Bank pioneered the art of off-balance sheet entities. They called them special purpose vehicles, SPVs, legal ghosts that could hold assets without officially belonging to anyone. Hedge funds adopted this architecture almost immediately. But the most ambitious minds realized it could go further, that if you could create a fund that existed across multiple jurisdictions, a Cayman holding company, a Luxembourg feeder, a Delaware management firm, you could build a machine that was untouchable. That machine became the foundation of the underground hedge fund system. One of its first true visionaries was not a banker, but a lawyer, Edward Lang, a quiet British solicitor known only to a handful of insiders. In 1993, Lang drafted what became known as the Phantom Trust. It was an elegant concept, a trust within a trust, owned by another trust, each located in a different jurisdiction. The true owner's name never appeared on paper. On record, the fund was controlled by a charitable foundation in Liechtenstein, whose listed director was a retired fisherman from Malta. Behind this absurd chain, however, were billions of dollars in private capital from Russia, Saudi Arabia, and even Western corporations seeking plausible deniability. Lang never broke the law. He simply redefined IT at the same time. A different kind of architect emerged from the intelligence world. After the Cold War, Western intelligence agencies were quietly downsizing. Dozens of former analysts and field officers found themselves jobless, but their skill set was perfect for another kind of operation, financial surveillance. One of them was Michael Mick Hansen, a former MI6 operative turned consultant. He understood that information, not money, was the real currency of power. Hansen created networks to track global trades, using private data sources and leaked corporate filings. But rather than selling this information to governments, he sold it to funds. These funds could predict moves in currency markets days before public data caught up. They weren't speculating, they were orchestrating. Hansen's methods would later evolve into what insiders called dark analytics. the use of non-public intelligence to manipulate market sentiment, that be why the late 1990s. Hidden hedge funds had found their ecosystem. They thrived in the cracks between financial centers. Money flowed from Zurich to Dubai, from London to Curacao, from New York to Nassau. Every time regulators tried to close one loophole, two new ones opened. The shadow architects knew this game better than anyone. They worked in patterns. A trust here, a nominee company there, a power of attorney buried under 12 signatures. What began as legal tax planning evolved into a system of institutional secrecy. They even developed internal slang for it. Ghosting, when a fund dissolved overnight and reappeared under a new name with the same assets. Chameleoning, rebranding of funds declared. Strategy to hide its real trades. Burning. The latter, erasing every digital trail of incorporation once the structure was operational. To outsiders, these funds didn't exist. To insiders, they were the new aristocracy of finance, beyond governments. Beyond accountability. In 1998, an incident quietly revealed how far this hidden system had grown. When long-term capital management, LTCM, collapsed, a legitimate hedge fund run by Nobel laureates, regulators discovered dozens of parallel entities mirroring its trades. These copycat funds had been betting against the same assets, sometimes using insider order data. They were identical to LTCM's positions but had no legal connection to the firm. The discovery terrified Wall Street. It meant someone, somewhere, had access to real-time trade data from multiple banks, a feat only possible with insider cooperation. The FBI opened an inquiry. It went nowhere. Every company traced ended in a shell, owned by another shell. Eventually, the case was buried under the chaos of the Asian financial crisis. But to those who knew, it was a revelation. The shadow world wasn't an anomaly. It was an ecosystem, vast, coordinated, and invisible. By the early 2000s, the architects had refined their blueprint. A standard shadow fund structure looked like this. A holding company in the Cayman Islands, for secrecy. A feeder fund in Luxembourg, for legitimacy. A management entity in Delaware, for access to U.S. markets. A nominee director in Malta or Panama, to mask ownership. The money flowed in circles, never staying in one place long enough to be taxed or traced. To the naked eye, these were just offshore entities. But to those who could read between the lines, they were weapons, financial black holes capable of moving billions in hours without detection. And their architects? They became legends whispered about in private clubs and conference halls. One banker once said, they built a financial internet before the internet existed. They coded the laws to serve them. By 2005, the global financial map had been redrawn. Traditional hedge funds were regulated, audited, predictable. But beneath them, in the dark, a network of private capital structures spanned continents. No regulator could fully understand it. No government could control it. It was a parallel system, one that could crash currencies, elect presidents, or topple economies, all without leaving fingerprints. And those who built it? They were no longer just architects. They had become engineers of chaos. It's been said that money is loyal to no nation. It moves where it's treated best. But in the underworld of hidden hedge funds, money doesn't just move. It disappears. In 2006, an analyst at a London brokerage noticed something odd. Overnight, hundreds of millions of dollars were flowing through the foreign exchange markets. Yen into dollars, dollars into euros, euros into gold, and then vanishing into accounts in the Cayman Islands. The trades were perfectly timed, always a few hours ahead of major political announcements. When regulators tried to trace the source, they found nothing. No corporate records, no fund managers, no clients. Only a chain of shell companies with names like Blue Stratos Holdings and Caraway International Trust. Behind one of them, investigators later discovered, stood a private fund operating out of a law firm in Geneva, registered under the name Vortex Global Strategies. It was one of the first confirmed shadow funds. The idea behind funds like Vortex was brutally simple. Exploit the seams of the global system. Unlike traditional hedge funds, which answer to investors and regulators, shadow funds were accountable only to their benefactors, ultra-wealthy individuals, political elites, and state-connected financiers who preferred their influence unseen. Each fund was a ghost fleet, dozens of offshore companies acting as ships, transferring assets across jurisdictions. Their managers were invisible. Their offices, if they existed, were no more than rented desks inside law firms. The money had no passport, no nationality, no conscience. During the late 1990s and early 2000s, this system became a silent weapon in the currency wars. One of the most striking examples happened during the 1997 Asian financial crisis. Officially, the collapse began when Thailand devalued the baht. Unofficially, it started weeks earlier, when anonymous hedge structures, many registered in the Caribbean, began shorting Asian currencies in perfect coordination. The amounts were staggering. In 1 week, over $15 billion left Southeast Asia, not through official bank channels, but via offshore accounts managed by intermediaries in London and New York. Many of those trades were later linked to dormant funds that had no recorded owners. They were, quite literally, money without a flag. To some, it was just capitalism. To others, economic warfare. The concept of financial neutrality became the justification. Shadow funds claimed they weren't political. They were simply using macro opportunities. But in truth, their trades often aligned with the strategic interests of major powers. When the British pound collapsed in 1992, George Soros famously made $1 billion betting against it. But behind the headlines, there were others, smaller, hidden funds that took parallel positions, amplifying the pressure on the currency. Many of those funds were later discovered to be connected to European private banks acting as proxies for foreign clients, including sovereign entities. It wasn't just a trade. It was a signal that even the Bank of England could be outgunned by invisible capital. By the early 2000s, the game evolved. Globalization blurred borders, and so did money. New tax treaties allowed funds to hide under layers of corporate ownership. Offshore banking jurisdictions like the Isle of Man, Guernsey, and Bermuda became epicenters of legal shadowing. Each jurisdiction offered a different piece of the puzzle. Cayman Islands for hedge funds, Liechtenstein for trusts, Delaware for anonymity, Singapore for liquidity. Put together, they formed a global infrastructure designed not for transparency, but for vanishing acts. Inside this world, secrecy wasn't just protection, it was a form of currency. A single introduction to a trusted fiduciary, a lawyer willing to sign his name as director for a dozen anonymous companies, could cost upwards of $250,000. Access to a private account in Zurich or Dubai with zero disclosure obligations required millions in minimum deposits, and so emerged a new class of financiers, not bankers, not brokers, but intermediaries of shadows. They were called cleaners. Their job was to wash capital, not from illegality, but from identity. As one former banker described it, it wasn't about laundering dirty money. It was about laundering rich people's existence. They wanted their money to be free from the gravity of nations. In 2011, a confidential IMF report, never publicly released, but later leaked to journalists, estimated that nearly $21 trillion in global wealth was held in offshore entities, an amount equivalent to the combined GDPs of the United States and China at the time. But the shocking part wasn't the total. It was the ownership structure. Over 60% of that capital was traced to fewer than 100,000 individuals, a micro-elite of the global economy. Within that, regulators identified several black pools, collections of funds used exclusively for high-risk, high-impact trades. One pool, codenamed Project Neptune, operated out of a private office in Luxembourg. Its directors were all former employees of major European banks. Its total capital? Over $80 billion. None of it declared publicly, no prospectus, no investor list, no oversight, only a pattern. Every time political instability flared, in Greece, Ukraine, Venezuela, or the Middle East, Project Neptune appeared in the data, moving billions between currencies, commodities, and sovereign bonds. When asked about it years later, a former regulator admitted, it was like watching a storm form before your eyes. You could see it, but you couldn't touch it. The money moved faster than we could think. In the aftermath of the 2008 crash, many governments promised to tighten control. They didn't realize they were already too late. By then, the architecture of secrecy was complete. Family offices, private investment vehicles for the ultra-rich, replaced hedge funds as the perfect cover. They didn't have to register with financial authorities. They didn't disclose their holdings. They could invest in anything, from arms to elections. And when global attention shifted to the rise of cryptocurrencies, the shadow funds moved again into tokenized assets, dark pools, and untraceable cross-border trades. The medium changed. The mission didn't stop by 2020. Global regulators faced an uncomfortable truth. Money had become stateless. It didn't belong to governments, banks, or even the corporations that handled it. It belonged to a network, one with no headquarters, no ideology, no flagged as one insider from the European Central Bank told a journalist. We built a globalized world assuming money would serve the system. We didn't realize the system would end up serving money. And that, more than anything, defines the invisible empire. An empire that doesn't conquer land. It conquers reality itself, one transaction at a time. It began quietly, as most revolutions do, not with gunfire, but with a wire transfer. In 2014, during the height of a European election cycle, over $120 million flowed through a web of offshore accounts and ended up financing political media campaigns across 3 countries. None of the donors were traceable. The names on the transfers belonged to dissolved companies in Belize, Samoa, and Panama. When journalists investigated, they stumbled upon a shell structure linked to a fund operating under the codename Arabis Capital. Its strategy? Macro-political arbitrage. Its goal? Influence. Arabis wasn't alone. It was part of a broader transformation, the moment when hidden hedge funds stopped being just financial predators and became political weapons. In the late 2000s, the shadow capital world realized that markets and governments were 2 sides of the same coin. Political instability could move currencies faster than any algorithm. Elections could change regulations overnight. Wars could rewrite commodity markets. And if politics could move money, why not use money to move politics? The first generation of hidden hedge funds saw politics as risk. The new generation saw it as opportunity. The transition began during the sovereign debt crises of the early 2010s, when Greece, Portugal, and Italy teetered on the edge of bankruptcy. Traditional investors fled, but a handful of anonymous funds stepped in, not to help, but to profit. They began buying credit default swaps, CDS, essentially bets that those countries would fail to pay their debts. The more unstable the governments became, the more valuable those swaps grew. And so, behind closed doors, political instability became a tradable asset. Leaked emails from an offshore consultancy firm later revealed that some of these funds were even amplifying political turmoil, sponsoring media outlets, funding anonymous political ads, and quietly backing extremist parties whose rise would push markets into chaos. One internal memo read, "Volatility is not risk, volatility is yield." It was a new kind of market strategy, political trading. One of the earliest and most effective examples was the Italian referendum of 2016, when a vote on constitutional reform triggered a brief financial panic. In the months leading up to the vote, anonymous funds, many registered in Luxembourg and the Isle of Man, began shorting Italian banks. When the referendum failed and the government resigned, the market plunged, and the hidden funds made billions. No one ever proved collusion, but insiders later confirmed that one fund had financed targeted misinformation campaigns designed to sway public sentiment. That it was an ideology. It was strategy. The same pattern appeared in emerging markets. In Venezuela, during the collapse of its economy, several Caribbean-registered entities bought huge quantities of defaulted sovereign bonds at pennies on the dollar. Later, when political factions sought legitimacy, those same funds financed lobbying groups in Washington and Brussels to push for debt restructuring. In return, the new governments agreed to honor the bonds at face value. For every dollar invested, the funds made no army in history ever conquered a country so efficiently, but perhaps the most chilling example came in Ukraine. In 2013, months before the revolution, a small fund incorporated in Malta, Northbridge Partners Limited, began quietly purchasing agricultural and infrastructure assets across the region. The transactions were routed through Vienna and Zurich, disguised as private investments. After the government fell, those assets, once worth millions, became critical to reconstruction efforts. Northbridge sold them to Western conglomerates at enormous profit. Years later, leaked correspondence revealed that Northbridge had received direct financial backing from an offshore trust associated with a European intelligence-linked consortium. They weren't betting on markets. They were shaping them. By the mid-2010s, a new financial weapon emerged: data. Shadow funds began hiring data mining companies to model political behavior. They tracked voter sentiment, media narratives, and even social media engagement to predict political outcomes. The line between political consulting and market manipulation blurred completely. An executive at a London analytics firm later admitted, "Our clients weren't governments. They were funds. They didn't care who won. They cared how fast the market would move when it happened." It was the birth of algorithmic geopolitics, a world where political chaos was not a crisis, but a predictable event to be monetized. As Western democracies grappled with rising populism, the influence of these shadow funds deepened. In Brexit, billions were made by funds that bet on the pound's fall. Several of them were later discovered to have ties to political data firms involved in online campaigning. When questioned, one fund manager famously said, "We don't take sides. We take positions." To the public, the referendum was about sovereignty. To the shadow traders, it was about volatility. By the 2020s, even large institutions began to suspect that markets were being subtly choreographed. Every election, every policy shift, every sudden wave of misinformation seemed to coincide with invisible capital movements: shorts, derivatives, swaps, timed too perfectly to be chanced. In private meetings, some regulators began using a phrase that had once belonged to conspiracy theorists: financial statecraft. A quiet war fought not with tanks, but with trading algorithms. Not for territory, but for leverage. The irony is that the same governments now fighting against these shadow funds often depend on them. During crises, when liquidity dries up, central banks rely on private capital to stabilize markets. That capital often comes from the very networks they claim to oppose. It's a Faustian pact, one no one dares to name. A former IMF advisor once summed it up bluntly: "They own volatility. We own debt, and debt always obeys volatility." Hidden hedge funds no longer just bet on markets. They manufacture uncertainty because uncertainty pays. And while politicians argue over ideologies, invisible money continues to decide who wins, who loses, and who gets to rebuild the world after the storm. It's often said that crises reveal character. But in global finance, crises reveal opportunity, and nowhere is that truer than in the shadows. When the world burns, someone, somewhere, is buying the ashes. In September 2008, the financial system was collapsing. Lehman Brothers had just declared bankruptcy. AIG was on life support, and panic swept through every trading floor on the planet. Central banks were calling emergency meetings. Investors were dumping assets. Governments were begging for calm. Yet, while the public watched Wall Street crumble on television, a parallel network of unregistered funds quietly prepared for the moment they had been waiting for. These weren't hedge funds bound by disclosure rules or risk committees. They were dark capital pools designed to operate when visibility became a liability. Their trades began hours before the official collapse, shorting mortgage-backed securities, buying U.S. treasuries, and speculating on the implosion of European banks. Later investigations found that one previously unknown Cayman entity, Ecliptica Holdings Limited, made over $2.4 billion in profit within 3 weeks of Lehman's bankruptcy. It had no known owners. Its listed director was a 78-year-old retiree living in Gibraltar who swore, under oath, that he had never heard of it. The real controllers were hidden behind 5 layers of legal intermediaries, and according to a leaked internal memo, Ecliptica's strategy had been modeled on private data from major investment banks months before the crisis hit. Someone knew it was coming. This pattern repeated again and again. Crises were no longer accidents. They were foreseeable events. And for those who could see first, they were extraordinarily profitable. When regulators later reviewed market data from 2008, they discovered a surge of coordinated trades across unregulated platforms, dark pools. In the 72 hours before Lehman's failure, billions of dollars moved across borders, invisible to exchanges. Many of these trades originated from the same handful of offshore structures. The shadow funds described in earlier chapters the outside world, they were ghosts. To those inside the system, they were architects in 2010. As governments struggled to rebuild, these same hidden funds began buying distressed assets, mortgage portfolios, infrastructure, and even entire towns. They called it crisis arbitrage. They bought cheap, waited for recovery, then sold to sovereign wealth funds and pension managers desperate for yield. By 2013. The profits from crisis-era acquisitions exceeded $800 billion, and while the public believed in recovery, the shadow capital world moved on, searching for the next disaster. They didn't have to wait long. The COVID-19 pandemic became the largest transfer of wealth in modern history. When lockdowns began in 2020, markets plunged. Oil prices turned negative, airlines collapsed, and trillions were wiped from global equities. But beneath the panic, certain funds were already in position, betting not on the fall, but on the response. One London-based family office, codenamed Argent Bridge Partners in leaked documents, purchased massive stakes in logistics, vaccine technology, and data infrastructure within days of the first lockdowns. Its trades mirrored policy decisions weeks before they were announced. Investigators later found that its subsidiaries had close ties to health technology lobby groups advising European regulators. Officially, it was coincidence. Unofficially, it was perfect timing. By the end of 2021, Argent Bridge's portfolio had tripled in value, over $40 billion in gains while the world economy lost trillions. But COVID was more than just a health crisis. It was a test, a live simulation of what happens when the entire planet freezes. Governments printed money. Central banks expanded balance sheets. Debt exploded. In that chaos, hidden hedge funds learned something critical. If you control liquidity, you control reality. They began offering emergency financing to struggling corporations through private intermediaries. In exchange, they gained control, not just of assets, but of information. When the pandemic reshaped industries, it wasn't only technology firms that benefited. It was the funds that owned them, silently and indirectly, through offshore networks. Then came the energy crisis of 2022, triggered by war, sanctions, and supply disruptions. For most of the world, it was a catastrophe. For shadow capital, it was a harvest. While gas prices spiked and nations scrambled for energy independence, a handful of secretive commodity funds, operating through Switzerland, Dubai, and Singapore, took long positions in natural gas and coal futures months before the escalation. These weren't random bets. They were informed moves. Insiders at energy companies, shipping firms, and even ministries had fed them early signals. A leaked correspondence between two brokers at a Geneva trading house reads, "They knew before the tanks moved." Someone always does. When the conflict began, these funds made astronomical profits. In one quarter alone, the top 5 anonymous commodity structures, none of which officially existed in financial registries, earned over $12 billion. That money then flowed into real assets, farmland, rare earth mines, data centers, and logistics hubs. The future, once again, was quietly being bought in the dark. By 2023, crisis investing had evolved into an art form. Shadow funds no longer waited for chaos. They engineered it. They funded think tanks to spread economic panic. They shorted markets before policy announcements. They created social media disinformation to accelerate fear. The result was predictable: panic, followed by profit. As one former fund manager admitted in a private interview, "You don't need to start the fire. You just need to make sure the wind blows in your direction." What makes these funds untouchable isn't their money. It's their structure. Each layer of ownership is a firewall. Each jurisdiction is a shield. Even when one shell company is exposed, a dozen more take its place. In effect, the financial system itself has become a labyrinth built by and for invisibility. And when governments seek help to stabilize collapsing economies, it's often those very same funds that provide the loans, at a price. That a senior EU advisor once said, "We spend our careers regulating banks we can see. The ones we can't see are the ones writing the rules." By the time the world emerges from one crisis, the next has already been seeded. The architects of shadow capital don't just bet on the end of systems. They plan for their rebirth. Every collapse transfers power upward. Every bailout consolidates control. And in the silence between catastrophes, the invisible empire grows stronger, richer, and harder to trace. Because to them, crisis is not a tragedy. It's a business model that it's the year 2025. Financial markets hum with artificial stability, predictable, algorithmic, efficient. But behind the screens, the real economy is run not by governments, not by Wall Street, and not even by central banks. It's governed by networks of invisible capital, money that exists beyond borders, beyond regulation, beyond the reach of law. The age of transparency is over, and no one noticed when it happened. The first signs appeared long before. When regulators demanded greater disclosure after 2008, hidden funds simply evolved. They no longer needed to hide money in traditional offshore havens. They moved to digital shadows, private blockchains, tokenized assets, and synthetic derivatives, designed to exist outside any centralized registry. What began as a crackdown on secrecy became its perfection that a single smart contract on a private blockchain could represent ownership of a $500 million asset, a building, a mine, even a national bond. No one could trace the true owner. On paper, transparency had never been greater. In practice, it had never been easier to disappear. By 2022, more than 30% of global financial transactions were routed through non-bank intermediaries, private funds, family offices, and algorithmic trading networks. By 2025, that number had surpassed 50%. The traditional banking system was no longer the backbone of finance. It was the facade. Governments believed they were regulating money. In truth, money had already gone somewhere they couldn't follow. A former analyst for the Bank of England put it bluntly, "We don't track capital anymore. We track data about capital. And even that data is owned by private firms." The most powerful institutions today don't hold assets. They hold visibility through control of data flows, financial algorithms, and proprietary analytics. They decide what the world believes is real. Stock prices, bond yields, and inflation numbers are no longer reflections of reality. They create it. And in that world, whoever controls the information defines the market. Hidden hedge funds understood this first. They invested not in industries, but in infrastructure, the invisible plumbing of finance, clearinghouses, data vendors, and AI-driven trading platforms. One internal memo from a European intelligence unit summarized it chillingly. If you own the pipe, you own the water. If you own the data, you own the truth. The line between legitimate and shadow finance no longer exists. Family offices that once served as private wealth managers now operate as full-scale investment empires. Multinationals structure their internal capital flows through the same secrecy networks once reserved for illicit funds. Even central banks, through partnerships with private entities, now rely on algorithms created by the very firms they claim to supervise. The system has eaten itself and called it efficiency. In 2024, a quiet event marked the end of an era. The Basel Transparency Initiative, a last-ditch attempt by global regulators to enforce real-time tracking of large capital movements, was officially suspended. The reason, ironically, was lack of cooperation, not from banks, but from governments themselves. Too many politicians, too many state-linked investors, and too many national funds were entangled in the same opaque networks they claimed to fight. A leaked diplomatic cable from a G20 summit read, "There is no longer a clear distinction between legal capital and hidden capital. They share the same infrastructure. We are the infrastructure." What began as a rebellion against oversight had become the system's foundation. Shadow capital was no longer hidden. It was normalized. The Cayman Islands, once synonymous with secrecy, are now home to offices of the world's largest asset managers. Luxembourg openly advertises its privacy-first investment laws. Singapore markets itself as a trust jurisdiction for the digital age. In other words, the shadows went mainstream. Transparency, once seen as a moral necessity, became a liability. The more visible an institution, the more vulnerable it became to market pressure, activist attacks, and cyber threats. Corporations, governments, and even NGOs began adopting the tactics of hidden funds, complex holding structures, silent partnerships, nominee directors. They justified it as security. But secrecy, once a symptom, had become the cured AS1 investment lawyer in Zurich said. In the modern world, only invisible capital is safe capital. The consequences go beyond finance. When power moves off the books, democracy loses its gravity. Campaigns, policies, wars, all can be influenced through invisible funding, algorithmic trading, and coordinated capital shifts that no voter can see or understand. Money no longer funds politics. It is politics. And while the public debates ideology, invisible networks decide the shape of nations. So, what happens when the world's most powerful system becomes untouchable? The answer is already here, in quiet corridors of data centers, in private meetings between fund managers and ministers, in the coded transactions flowing across continents every millisecond. It's a new world order without leaders, borders, or faces, not an empire of nations, but an empire of numbers, self-correcting, self-expanding, self-protecting. And when history looks back on this age, it may not speak of revolutions or wars. It will speak of the moment humanity lost sight of where its money ended, and who truly owned it. In the end, transparency didn't die in darkness. It was simply priced out of the market. Epilogue: there's a theory among economists that every financial system eventually reaches the point where it can no longer distinguish between creation and manipulation. At that point, stability is just the illusion of balance. And perhaps that's where we stand today. A civilization of glass towers and mirrored screens, built on the oldest truth in human history. The greatest power is the one you never have to show.